Welcome to Streams of Income with self-help author Ryan Rieger. For the next hour, you'll hear proven methods for how to live the multiple income streams dream. Ryan is passionate about helping others discover their gifts and start their own business. He's published 5 books, and his courses and group coaching programs have changed the lives of thousands of students all over the world. Ryan's books include Private Label, The Easy Way, Finding Your Grace Place, and his latest, Streams of Income. And now, here's your host, Ryan Rieger.
Hey guys, welcome back to the Streams of Income radio show. I'm your host, Ryan Rieger, and today we're talking with my good friend and returning guest, Mark Willis. Mark has been on several times on this podcast, and I keep coming back to him because he's always a wealth of information, and he has a unique way for my family and I and many of my students to build wealth. And Mark is the best to explain this. He'll do way better than I ever could to explain how all this works. But we are able to essentially be our own bank. We're able to earn money, use that cash, and it still earns interest even when we use it for vacations or to pay off debt or to build a business, to buy inventory, whatever you need it for, the money still is earning interest for you as if you never took it out. And so it's just a really powerful strategy. But today we're talking about how to use a policy like that for paying off debt and how he's coined the term snow bank method. And he goes step by step into how to use a policy like this to pay off debt and still have cash available. So really cool. I highly recommend you either check out this episode and the other episodes that I've had with Mark. I'll have a link in the show notes to all those other episodes because they're just very eye-opening. This is something I didn't even know existed a few years ago, but we've had our policies, plural, since about 2016, and they've been a game changer for us in our finances. And it's guaranteed, super crazy safe. And you'll just love Mark. He's a great guy. By the way, book a free call with him, ryanrieger.com/bank on yourself. And you can book a really quick call just to go over your situation. He'll let you know right up front if it's not a fit for you. Very low pressure, really good guy. But here is my episode with Mark. Mark, welcome back to Streams of Income, man. What a pleasure.
Thanks, Ryan. I was telling you earlier, I was looking forward to this all day, and I can't wait to get into the meat and potatoes here, man. Thanks for having me on.
I know we don't have a lot of we got plenty of time, but before Evie walks in there and needs daddy time.
That's right. We're both fathers that work from our home offices, and there's some great benefits to doing that. Gives everybody a chance to run in your door whenever you want. But it's also a chance to save on the commute going back home every day.
Absolutely. Would you do this any other way? I mean, could you imagine like having to go to a regular job and
No, it's gorgeous. It's gorgeous outside. I can walk. It can take me 30 seconds to grab my daughter's hand, run outside, go play in the backyard,
wow.
Within half a minute of being done.
Yeah.
How many people can do that? We're living in it's a blessed life.
It really is. Do you guys go to the zoo and stuff like that in the middle of the day?
Last week was the last letter of the alphabet. It was Z week around our house. We're doing a letter a week. And so we did the zoo last week, actually.
Really? Yeah. That's awesome.
Yeah. And it's sort of surprised me when she said like one of her favorite animals was the snow leopard, because it looked right at her, like just beyond the glass, in the little spot that the snow leopard lives in. It was like staring her down like she looked like an appetizer. And of course, I'm Papa Bear, trying to like, how am I going to hope this glass is thick enough?
Right.
So it was good times. Yeah. Yeah. How about you guys? Are you guys getting out there and enjoying some sunshine?
We do. Yeah. He loves the playground. He could spend out there all day, go out there all day. Being an only child right now, he needs that. He's very social. So he'll just walk up to kids that are playing that are even a lot older than him and just start jumping in. Sometimes that's received really well. Sometimes they're like, kind of get away, kid, you're too little for this. But
he's going to be a great business owner someday.
Yeah,
you just got to sometimes do that, right? As in business,
just jump in and we do
figure out what you can do. We
have a blast. So I always enjoy having you on, and let's just jump into it. What are we talking about today?
Yeah, the conversation you and I kind of bandied about before we hit record, I think really has been hitting me between the eyes lately with a lot of the conversations I have with clients. As a certified financial planner, I meet with folks one-on-one in a confidential advisory role all across the country. And I've had the privilege of working with many of the awesome folks you know and work with and love so much, Ryan. And so it's always an honor to get to chat with you and to chat kind of with you, with the crowd listening too.
Yes.
A lot of the discussion I'm hearing, especially now as a lot of the government support is being pulled back in terms of like monthly income and deferral of student loans. As we're recording this, that's still being debated, but people are kind of getting quote unquote back to normal with regard to bills and income. We're also hearing a lot of people say that there's supply chain issues and there's issues with their just the revenue off their business. They're starting to see a lot of the PPP loans start to coming in and starting to be paid on. A lot of folks are seeing just they're struggling. And I was looking at some statistics. According to the Small Business Administration, when you start a business, this could be very small. I mean, we're talking $5,000 to start your business, right?
Yeah.
Or less even. They say, according to the SBA, that according to startup financing, 77% of small businesses drain the savings account to start the business. 77%. 19% also, and this is going to total more than 100%, I realize, because some people use multiple sources to start that business. But 19% use bank loans. 10% use credit cards. Another 10% are using personal assets, like they're selling the house or mortgaging the house. Another 7% are using other sources like family money, grants, venture capital money, home equity. Government loans are only at 2.3%. That's the SBA loans there. So I'm trying to figure out, like, how do you run a business when other people have so many hands in the pot, so to speak, or you've drained your personal savings to start that dream, right? I don't know. What do you notice? You deal with quite a few entrepreneurs, Ryan. Do you have any discussions about how they're going to fund their business by the inventory?
The cool thing about what we teach is that you literally can start with $0.
Right.
And so you don't have to. I mean, a lot of people that come to me, they kind of know what I do. And so they're already a lot of them are geared towards the selling physical products, as I have a large community of people that sell on Amazon. But you can get started with under $500 and many times literally zero, because with the strategy of consignment, going to, like, Mark, if you and I were neighbors and I knew that you had a bunch of stuff in your garage and Katrina was telling that, get this stuff out of here, Mark, or we're done. Like, I could go to Mark, I'll help you out here. Let me take all this stuff. I'll sell it for you and we'll split the profits. Your wife will be happy. And I'll be happy because I didn't have to spend any money to get that inventory. Or I got stuff sitting in my garage that I know right now, if I was really in trouble financially, I could sell some stuff that we have that we're not using, that I could pop it up on Facebook Marketplace and have cash tonight. Those are the strategies we teach. So not very many people listening to me on Streams of Income are going out and borrowing money to start their business. They just don't have to. Some do. Some will buy inventory on a credit card after they've gotten started. But that's why I love what we do, is just because it's so low risk. Just there's very little investment needed. So, but people are still struggling. I get emails from people that are struggling all the time. And and your story involved just consignment and kind of working to kind of split it was furniture, if I recall, right? Yeah, exactly.
Awesome. And I meet a lot of people on the Amazon side who maybe they've started with no debt, but then they've stumbled into it with inventory, not selling as fast as they thought. And it's credit cards, or it's Amazon lending, or it's payables, or it's Cabbage, or some of these other business lines of credit. And a lot of these rackets can be double-digit interest, 10, 20. I've seen 60% interest rates on some of these. I mean, that's worse than credit cards.
Right.
And you think it's not bad because, hey, I'm only going to float for 10 days, 20 days, 40 days, whatever. And that's on the business side. But then over here on the personal side, even if we're running our business with a tight ship and we're just doing consignment or retail arbitrage or something like that, on the personal side, we could still be, surprisingly, hit with multiple kinds of debt. I mean, the student loan debacle is at 1.6 trillion right now. Credit cards are just chasing that. Mortgage debt is now going up. We have an average mortgage now of 5.25% as we're recording this, which is almost double what it was last year this time. Now, a lot of this is just been floating around in the ether. We've been able to sustain this amount of debt because our interest rates have been so low. I mean, as long as you and I have been alive, basically, Ryan, interest rates have been just coming down. And so we're about to experience, or we are experiencing, the first time for us anyway, a rising interest rate world. And it's not slowing down yet. I don't know how this ends. No one's got that crystal ball, but debt certainly has it's got a, hands around our neck as a country, and not just as a country, but also as families.
Right.
And for those that are struggling, I just want to say there's hope. There's possible outcomes, but boy, it also takes strategy. Hope is not a strategy. We need hope and we need strategies.
Absolutely. That's right. And that's why you're here. Discuss some one.
Just going to pass money out to everybody.
At least one idea to do this.
We're just going to get helicopters of money. Ryan.
That's right.
That's the goal.
Isn't that what the government does?
That's promises? Right. Yeah. Yeah. No, that's there are better and worse ways to become debt free. And I'll tell you a story. My family and I, my wife and I, we graduated in college. We had really no awareness of money. We didn't really understand what it was for, except just to pay the bills and so forth. But we stumbled our way through college, mostly me. She did a better job than I did, but we had about $120,000 of student loan debt.
Wow.
When we graduated. Now, if that was in today's money, that'd be about 220 grand, 230 grand. And you have to realize too, we weren't like lawyers and doctors. Okay. We did not have marketable degrees when we graduated. It was like, also it was 2008 when we graduated, right? So was that a good time to be looking for work? Remind me.
No. I remember 2008.
Yeah.
Not at all.
So it was sort of like March 2020, right? All of a sudden, the world kind of freaked out for about a year, and we all have this wonderful rose tinted glasses looking back on 2008. You have to realize that we didn't know like if the banks were going to be open the next day for a good chunk of that year, second half of that year. And when the banks aren't open, the grocery store is not going to be open.
Yeah.
And when the grocery store is not open, we can about bet that the world is ending, at least around this house.
That's right.
So we did not have a plan.
And we didn't have DoorDash then.
No DoorDash. That's right. Yeah. Thank God for DoorDash, Instacart, all of them. They belong in the streets of gold too.
Right.
So I was just reflecting the other day on really the severity of our situation in 2008. We were young kids, just out of college, whatever. And so we got serious about our budget, started working side jobs. Anybody who would pay us over the table, under the table, it didn't matter to me. It was waiters and tips and all that stuff.
Yeah.
And so we would just try to knock out the debt with good old Dave Ramsey's Snowball. And he did so many wonderful things for my relationship with money, my relationship with my marriage, with my wife. And so I got to give him a lot of credit for just getting me, as he says, gazelle intense, getting me intense about paying off the debt.
Yeah.
Now, I would not necessarily say that he's got the corner on truth, especially when it comes to the entirety of the financial universe. Like he didn't write the fifth gospel, he's got his own opinions, his own bias, right?
Sure.
And as it turned out, we did get a lot of benefit from his baby steps, but over time I began to realize that baby steps are not going to win a marathon, and my life shouldn't be stuck on baby steps, right? Like if your son Callan was still doing baby steps at his age, that'd be a problem. If you were still doing baby steps, if I was still doing baby steps, that'd be a big problem.
Right.
So we have to decide for ourselves, thinking critically about money. How do we do this? How do we manage? It's an adult problem. It takes an adult solution when you get into that kind of debt, whether it's credit cards or student loans or, other things. Brian, before keep blabbing on. Any feedback coming?
This is really good. This is reminding me of a conversation I had with somebody several years ago, that she said Dave Ramsey is wonderful, but he's more for the person who has just a regular job than entrepreneurs, because as entrepreneurs, what he doesn't usually talk, and I have to be honest, maybe he does talk about this more now, but it seemed like it was all about cutting expenses rather than building income. And so if you have a job where you're only going to make $50,000, that's all you're going to make, and you can't, there's no prospect of making any more. You don't want to get a side job. That makes sense. You're going to have to cut. You're going to have to do something if you don't want to earn extra money. But for us as business owners, she was saying that, a lot of it doesn't apply. I mean, yeah, it's very smart to cut out things you're not using. You want to be a good steward of your money, of course. But we as business owners have the opportunity to create extra income so that we can, I want to be able to afford Starbucks. Mm-hmm. I want to be able to take my kid to the zoo when it's not Wednesday, a half off day, Right. And so, I'm thankful that I have a position where I can, send out an email and get people sending me money for a course I've created and earn extra cash to be able to go on vacation. So just a sidebar there that I feel like.
No, Ryan, you're exactly right, man. I think, if you ignore either side of the seesaw, you're going to get caught. Mm-hmm. You got to tackle that beast of rising expenses. Mm-hmm. It's the Parkinson's law that says that expenses will rise to meet your income. Mm. You're right. Isn't that true? Yeah. Isn't that true? All of a sudden, that nice car, you get that nice bonus at work, and all of a sudden, there's that nice car waiting for you at the car dealer. Right. It's just up and in the ante. Also, they say a luxury enjoyed becomes a necessity, and that's so true too. I mean, we're up in Chicago, and heated car seats. Uh-huh. That is standard in this household.
Yes.
So I know that you have an incredible YouTube channel. You also publish this on podcasts. Is it possible for me to share my screen, or should we
go for it?
Just audio.
Absolutely.
Okay. I'll see if I can keep this sort of brief, but I figured I'd share. Whoops. There we go. See if this pops up. Does that pop up on your side there? Mm-hmm. The debt snowball?
Yes.
So I wanted to quickly explain the traditional way most people pay off their debts, which is known as the debt snowball method, and then show you an alternative way that my wife and I use to pay off our debts, and what a number of our clients are using as well. It's called the debt snowbank method. So a little play on words with old Dave Ramsey there. So this is the popular way here. This is known as the debt snowball method. And here are the steps. First, you list all of your debts from smallest to largest. Some people will also choose to go with interest rates first, but list all your debts, pick the one you want to tackle first, and make your minimum payments on all your debts except the smallest one. And with all your might, you'd throw as much as you could toward the one account that you want to pay attention to first. Usually it's the one that's the smallest balance, but again, you could also choose the highest interest rate first. And then you take those monthly payments that you used to pay off the previous debt, and you use that as the additional payment toward the next debt every time you pay off a debt, until that one's paid off, and then that one's paid off, and so forth. And meanwhile, while you're doing all this, kind of subsequently, or at the same time, you keep about $1,000 in your savings account. So, Ryan, $1,000 in the savings account. What could possibly go wrong there?
You have a medical expense, car that needs to be repaired, and then you'd have to, put that money back onto the credit card that you just paid off.
That's right. Yeah.
Or if I think Dave Ramsey used to speak about cutting up your credit cards, right? After you were paying them off. So then, got to go get another credit card.
That's right. Yeah. It's amazing because I've met enough people now that I've met people who've been on Dave's radio show, and they did the whole "I'm debt free" scream. Yeah. But they get to tell me the rest of the story. And they say to me, Mark, we fell back into debt. Yeah. And that's more common than you realize.
Yeah. I've heard somebody talk about that too. A mutual friend of ours said, I can just say probably he wouldn't care because he's very open. Josh Tolley says that inflation is the killer of that situation. If those people that are debt free, that's awesome. Praise the Lord for that. But then if they're still making that same income, still making that same $50,000, well, next year that $50,000 is only worth 48,000, and so now they're back into debt again because they're not getting pay increases.
Right. Yeah, that's so true. Wow. Well, you're right. Inflation is a big part of our conversation in the news these days too. So the next step I wanted to show was quickly like, well, okay, Mark, so debt snowball, that might not work. Well, what can we do? Here's a picture of something we generally think about, but don't necessarily see. And that is, hopefully you can see this whiteboard here. I'm drawing, for those just listening, I'm drawing a horizontal line across the screen. And I want that to sort of represent time in our life. And in the center of this line is the number 0. So when you're born, at the beginning of your timeline, you have a net worth of 0, let's say. And also, there's no U-Hauls behind hearses, so I guess you end at 0 as well.
Yes.
All right. So everything in between is sort of the story we're trying to work out. What's the best way to deal with this money thing? Now, if you needed a car this afternoon, Ryan, let's just say you had no money at all, no assets, nothing at all, and you must have a car this afternoon. What's the only way to get that car?
Steal it.
Steal it. Good answer. Well, I had never heard someone answer that way before, but that is a great answer.
I mean, I guess, okay. So, I mean, the legal way, you have no money?
The legal way. Yeah.
I guess you, wow.
I'm never letting you drive my car, Ryan.
Legal, you have no money whatsoever. I get, you'd have to, I mean, you go out and get a loan, I guess, right?
You'd have to get a loan. You got it. Yeah. Or steal it. So now I'm drawing a line below net 0. And now what's going to happen 30 days after you get that loan? They're going to ask you for a month of
for
payment,
your first
right?
payment.
Yeah, that's right. They're going to squeeze blood from the turnip, and you're going to have to climb and crawl and scratch your way back up to that net 0 line over the next 4 or 5 years.
Yep.
And what do you do once the 5 years are up and that car payment is paid off? Well, the new car smell is kind of gone. The kids are, busted the back window. It's kind of smelling sort of weird. You like the new car. So what do? You go back into debt for your next car, right?
Yep.
And you just continue the staircase. You fall back down the staircase and you climb back up. All the while, money is leaking out of your system. It's leaking out of your pockets and going to where? To the bank. The bank controls this whole process. And most people live their entire life. And quite literally, Ryan, it's a good chunk of our waking hours just being slaves to the bank. Yeah. Now, this was me climbing my way up the debt snowball, right? So what's the alternative? I guess I could have, saved up and paid cash for my education, or you could have not stolen my car. Thank you. You could have saved some money and saved some money in a savings account or money market or brokerage account or something and saved. Now I'm drawing a vertical staircase going up above that horizontal line. And now we've saved our money, whatever it was, 10,000, 40,000, whatever your car was going to be cost, whatever it was, going to cost. And now we've got a $40,000 bucket of money sitting somewhere and we're feeling pretty good. And it's earning a little bit of interest. Maybe it's pennies, maybe it's dollars, depending on where you saved it. Yeah. But what happens as soon as you take money out of your bank account? You crash back down to 0. And no matter what you were earning before, how much interest are you now earning on this money that you took out of the bank account?
No interest on 0.
That's right. 0 times anything is still 0. That's right. So the true cost of my car or your car or anybody's car, even if you pay cash, is not 30 grand or whatever the car might have cost. The true cost of your car is whatever that would have grown to over your lifetime had you not bought the car and just left it invested. Yeah. And then when we do withdraw money from our brokerage accounts or savings accounts or whatever, we've broken interest on that money for the rest of our lives. And then we got to also save up, right, for the next car or the next medical expense or whatever it is. So we keep just living this. It's almost like a mirrored reality to the debt staircase. In fact, Ryan, I would say that you finance everything you buy. Either you pay interest to a banker or you pass up interest you could have earned on your money had you not bought that car and left that money invested instead.
Right. That's
In
good. I
fact,
once heard Grant Cardone talk about, I think it was him, about the true cost of something. Like if he looks at a new suit and it's $1,000, I don't know what percentage he uses or what his, I have to go back. I could go back and look at pretty easily, but he multiplies it by 2 or 3 or 4 or 5, because that's what it might be in 20 years, and says, do I still want to buy this suit if it's $5,000? And sometimes the answer is yes. And sometimes it's no, I don't want to buy this suit for $5,000. It's
so true.
Worth that money to me. So
yeah, if you could just put, $350 a month, which would basically be a car payment or saving for your next car. If you could just put $350 a month into a savings account, and you were able to do that over how many cars you're going to buy over your lifetime, right? Probably 10 cars. If you're a young kid in your 20s, you're probably going to buy 8 to 10 cars over your lifetime. And if you put in $350 a month, earning 5% in some sort of savings account, let's say, and let me just do the math on that really quick. All right. And we're going to do 12 times, 720 months. All right. That's, wow. 720 months. Do you want to know the cost of buying your cars with cash? If you saved $350 a month and never took it out of an interest-bearing account at 5% over 60 years, that's $1.6 million.
Wow.
Hope you liked your cars.
Yeah. Man.
So that's the power of compound interest. The trouble is we're trapped on this line, this net zero line, and we can't get off of it because you got to buy your stinking cars, right? So is there a better way? That's kind of what I was forced to think about myself. And so that was kind of my discussion with my wife. What if there was a better way? What if there was something better than being debt-free? What if there was something better than just paying cash or just using a bank over and over and over again? The trap was to always pay cash or use debt. And so we came up with, discovered, found, and kind of refined something that we now have trademarked as the debt snowbank method, which is our tongue-in-cheek response to good old Dave. And yeah, it's just like it sounds. You're banking something. You're not setting up a literal FDIC insured bank, but in this case, we're using a tool that helps us, in essence, become the bank. It helps us buy back our debt. And maybe crucially for us, for my wife and I, it kept us liquid while we were doing that. Because again, the biggest problem that we found, besides that lost opportunity to grow our money, that was one mega problem. As we were throwing money into the hole of our student loans, we'd never see that money compound for me ever again. But we also had the problem of no access to cash. Like if we just tripped on the sidewalk or had a flat tire or something, we'd go back into debt all over again while we were trying to get out of debt. So by using the debt snowbank method, we were able to break free from our creditors and stay liquid, meaning accessible money at the same time. So it's a much more sane approach for becoming debt-free. Any feedback, thoughts on any of this, Ryan?
No, this is good stuff. I know exactly where you're going. So
okay.
and I've used this multiple times in my business and life, thanks to you.
Love it, man. Well, yeah, the tool we use is using a dividend-paying whole life insurance policy.
And wait, isn't that what Dave Ramsey says is bad?
Yeah, I know. That was the one thing that really almost cut me from moving forward on this. Yeah. Because I was so tied up in Dave's his reality distortion field. I would listen to his radio show every day, and I knew what he thought about whole life insurance. But as I finally got through a lot of my own bias and kind of preconceived notions, what we're talking about here is a specifically designed type of whole life. It's categorically different than what you'd hear Dave talk about on his radio show. And either he just doesn't know about this or he's not willing to make this exception. Either way, he's not giving you the truth that you might need to help you break free. Because it's added hundreds of thousands of dollars of wealth to my family because we paid off our student loan debt this way. Yeah. As opposed to just paying it off the old-fashioned way, the Dave Ramsey Snowball way. All right. So again, we're using a whole life policy designed the bank on yourself way. meaning it's got a ton of cash right away. We squeeze the death benefit, we squeeze down the commissions, we flood the policy with cash, whether it's $200 a month or more or less. The more you pack into that policy, the more you can have access to. And essentially, the steps are very simple. Once you've established kind of your list of debts, you list them all out, same as before, either by smallest to largest balance or highest interest rate, whatever you prefer. And you keep current on all those debts. We don't want you to go behind on any debt in this project. The next step would be to establish, set up, and fund a dividend-paying whole life policy, kind of engineer the bank on yourself way, and put everything else. Just go nuts funding that whole life policy. Put everything you can into there. The money that I was overpaying on my student loans early on in my project there, I should have been putting straight into one of these policies. Now, we finally figured it out about halfway through our project. Thank goodness. But everything you can squeeze in here comfortably, of course, going into a policy. That policy is accessible money. It's liquid, meaning you can get access to it for any reason. If there's a medical emergency or whatever, it gives you a pool of cash. Right away. Gives you a pool of cash right away. So there's no sense in fighting off the orcs at your front door if you've left the back door and the garage door wide open, right? Oh my God. So gotta get my Lord of the Rings reference in there. So it creates a bank of money, not talking about an FDIC insured bank. I'm talking like a snow bank or a food bank, right? Get it? And as you build up your storehouse of money, your bank of money becomes worth as much as your smallest debt. So I want you to imagine your debts are coming down slowly. Meanwhile, your policy is getting just flooded with cash, so it's growing quickly. And if you can imagine two piles of money in your mind there, at some point, that policy will be the same as one or all of your debts, and you can borrow against the policy and wipe out the debt. So that's step 3.
Yeah. Plus, you've bought insurance.
Right. Yeah. Yeah. Not to mention, you've solved that problem for your family in case you pass away. You're not leaving them with debt.
Right.
Yeah. So step 3 was, when you have enough cash value in your whole life policy, you take a policy loan to pay off your debt. Now, Ryan, why in the world would you do that? Like, aren't you just trading one debt for another? Why would you take a policy loan? Loans equal bad, right?
Normally, right?
Yeah.
Well, it's I guess, can I go on? Basically, my answer is always step 4, which is that that money that you took out continues to grow as if you never took it out. So that's, it's your money. But just the way it's set up is that, and you never have to pay it, but that's a whole other, I don't know if you want to get into all that, but I always like talking about that because it's when I first heard of this, is like, this sounds way too good to be true, but now I understand the inner workings of it a little bit more. But yeah, you can pay that debt off. It does lower the cash value that you have available to borrow more back. But then that money that you took out continues to earn dividends every single year as if you never touched it. Yeah. And I mean, it's better to pay it back. But even if you never did, let's say that insurance, you had $1 million death benefit, and let's say you borrowed $50,000 and you did not pay it back. Well, that means you would have lost that opportunity of that $50,000. That $50,000 is not going, it'll grow faster if you pay it back. But even if you don't, your family just will pay it back off of the death benefit. So pretty sweet.
You've taken a debt where other people were in control of your life, the banks, the banksters, as I call them, the credit card companies, the finance companies. You got them out of your life. You fired your bankers, and now you're sitting behind the banking desk of your own life. Now, I believe as a financial planner that you can pull on a lot of levers in your financial life. You could chase rate of return in the stock market. You could go grab some rental properties. You can fight inflation. You can pull all these levers in your life. You can cut expenses. You can, whittle down your taxes with your accountant. There's lots of things you could spend your time and money and energy working on. But my firm belief at this point, having seen over 1,000 clients across the country, is that whoever controls the banking function in your life will win your financial life. And if it's some other banker, they're going to win. I don't care what your mutual fund says it gave you last year in the stock market or whatever your tax rate was or whatever. What matters is who's the one doing the banking in your life. If you're the one who owns the bank, quote unquote bank in your life, you're going to win by default. And why is that? Because yes, when you can control the loan repayments, like turn it on, turn it off. If you get into a tight spot, you can stop the repayments for a while. Then you can turn them back on again. Just had a guy, this is a crazy story. I'll be brief here, but a gentleman who opened up a policy with me in 2015 to do this. He paid off a bunch of his debts, credit cards and more, did the Snowbank. I didn't know it was called that at the time, but he borrowed out, paid off all of his credit cards. And he has since paid back the loan to the policy. Now, why would he do that if he didn't have to? There's no requirement saying he has to repay it. Well, like you said, it kind of refuels the policy. The death benefit is made whole again. But meanwhile, again, the policy was still earning interest as if he had never taken that loan. And he has since used the policy for other loans, other needs, bought a car, helped his grandchild graduate college with some expenses there. Has since used the policy a number of times. In fact, he and I were on the phone. He was like, Mark, I don't know why my loan balance is this big. I thought I'd been paying on it for a long time. And I had to go back into the history and see that he had taken a $12,000 loan and totally forgot that he had even done it. And he had also stopped paying the loans for a while, and he'd forgotten he had done that too. Now, do you think a real bank would be that generous, right?
No.
Anyway, so that's step 4 is to realize that you didn't stop the compound growth in the policy when you paid off your debt. In fact, I actually don't say you pay off your debt. When you use the debt Snowbank, you're buying back your debt from your other banksters, and now you are the banker. You've bought it from them. And kind of like how your mortgage can get sold to another mortgage company or your student loans sometimes, you're buying that debt. You're playing the same game that the banks are playing. And you get to buy it back from the bank that you had their thumb on you.
Yes.
And now you get to control that asset. Now you turned your liability into an asset, which is what we did with all of our student loans.
Yes. I wanted to say something that I always I was going to look up the percentage here real quick because I'm not going to give out exact numbers here. The policy that you put together for my mom. And so any of you guys that have a business and you're thinking, okay, you can say you have an Amazon business and you're about to drop 10 grand or 20 grand in inventory. You're about to buy a piece of equipment. Maybe you have a prep center and you're wanting to buy a pallet jack or just anything that might be pricey that you're thinking, should I borrow money from a bank to do this or pull it out of my policy? Or let's say you don't even have a policy yet. Let's say you have 10 grand sitting in the bank right now. I always tell anybody to go grab a policy with this. Talk to Mark, grab a policy with this, because what that does, let's say that $10,000 that you have in the bank saved up to buy your inventory, buy your piece of equipment. Sure, you can take that and go buy that thing, but then your balance goes down 10 grand in your account. You're no longer earning interest on that 10 grand. But if you put it into a policy, Mark, correct me if I'm wrong, but that policy you put together for my mom, the amount that we were going to put in, you had it structured in a way that she had access to 91.4% immediately.
Yeah, that's right.
And so she could put that money in, and within just a few days after that policy is all set and done, whatever has to happen with the insurance company, she can go right back into that and borrow it. So for you guys that are business owners, $10,000, yes, definitely a portion of it's going to go to buy the insurance, all the fees, but the fees are reduced. You would have access to maybe $9,100 to go buy that equipment that you need. Plus you've bought insurance. So to me, it feels like you're double dipping here, because that 10 grand in the policy is going to continue to increase every year. And you still have your equipment that you needed, and your bank, and it feels like it is. It doesn't just feel like double dipping, because you are, especially if you're putting in an inventory. Your money's earning your money's earning interest in the insurance policy, plus you used it to buy inventory that's probably bringing you 20 to 25% return on your investment if you're selling on Amazon.
You're giving me goosebumps there, Ryan. That's awesome, man. I love it. And I would just add to that yeah, there's all sorts of creative scenarios here, and I want to also mention that it did cost your mom something to buy this policy.
Sure.
You mentioned it, right? You put in X dollars, and she had 91% of that. That means she lost roughly 9% of her money in the first year. Mm-hmm. So for folks that need every last penny right now and can't part with even a few pennies on their dollar, don't do this. I hate to say it, but it is there's always going to be upfront expenses. There was an expense, I'm sure, when you started your business, at least a few $100 of something, right? To incorporate your business, whatever. There's always going to be expenses with your real estate, but the key is, can we think long range? Mm-hmm. With your mom's policy, I hope you don't mind if I say it breaks even in year 3, right? Yeah. And that means that it was a single premium that goes in her case, but other folks, it might take longer than 3 years. Other folks, it might be shorter than 3 years. But the point is, it took a few years for it to break even. Mm-hmm. And that meant she had to be willing to be patient.
Yeah, but all the while, Mark, she gets something for that money because she's got a life insurance policy.
That's right.
She passes within that 3 years. Well, we're covered because that bought a life insurance policy for her.
You're right.
So,
you're right. That's so true. It's at the end of the day, this is life insurance, and that's what we're buying here. Yeah. And she did have and does have liquid access. Any person who buys a policy, if it's designed correctly, the money is available within usually a few weeks after you start the policy. So even though all of it's not there, 91 cents or whatever in her case, it could be 65 cents, it could be 85 cents, it could be 90 cents, just depends on the person's situation.
Right, because like for me, you've built it completely different. Like we're trying to maximize, for some people, they might want a huge death benefit. Some other people might want access to the cash right away. Therefore, it changes that percentage.
That's right. Yeah. But the main point is patient capital. I think we're very impatient in our world today. We want our rate of return from our cryptocurrency like instantly. But I would say you can either get rich quick or you can get rich for sure. I've heard it said. And this is one of those assets. The life insurance is an asset that grows on a guaranteed basis every single year. That's getting rich for sure.
Yeah.
In my book, and I would much rather have folks say, well, Mark, what's a good rate of return? And I say the best rate of return is the one you actually get. Right?
Yes.
Any kind of pie in the sky estimates from your financial advisor on Wall Street is just that. It's just hope and prayer, right? It's just pie in the sky. So I would much rather a get rich for sure, guaranteed cash value increase every single year than a hope and pray return that is worth as much as the paper it was printed on.
Right. So true. So good. And the other thing is, like, if I'm in business there, I'm going to need more equipment. So you can do multiple policies too. And so instead of like, guys, listen, like if you are constantly shelling out money for inventory, whatever, do it through the policy. Or if you have another piece of equipment that's going to come up in a couple of years and you have 50 grand in the bank to pay for it, buy a policy first, then get the equipment, because then that money is going to continue to grow and you get your piece of equipment. Plus you have life insurance.
I'll tell a quick story. I just spoke with someone in the Legends group yesterday, and I won't give too many details here, but they were doing well. Their business is doing fine, but they had racked up some credit card debt, and they had also started two policies with me about a year or two ago, two years ago, and they were like, "Well, Mark, we got this money sitting in our savings account. We're just going to probably pay off the credit cards. It's 30 something thousand in credit card debt. We're going to pay off those credit cards." And I said, well, okay, you can do that. But would you like me to calculate the cost of paying cash for your debt? And it turned out it was going to be about $210,000 over their lifetime if they just wrote the check and wiped out the credit cards.
Yeah.
Instead, what they're doing now is they're dumping that 30 something thousand in savings into their two policies that they had set up. See, they had created those parking spaces for their cash years ago. And they didn't know they were going to be in credit card debt this year. I mean, again, their business is doing fine, but they just wanted those pesky cards gone. And they had the money sitting in savings. Mark, why don't we just wipe this slate clean here? Why not put it into an ever increasing asset for you and your family and get that 210 grand starting right now, start to grow and accumulate and still pay off the credit cards rather than be debt free? I want to be the banker. I want to buy back my debt. And so that's exactly what they're doing with their cash. So good on you to them.
And even a little more advanced thing is this little thing called wiggle room in your policy that even though you set it up, I don't want to get too deep in the weeds on this, but even though you set it up for a certain amount, there's typically going to be, depending on how policy set up, some extra room in there to put more money into that. So even if you put it in and then take it right back out to pay off that debt, that's still better than directly paying off the debt.
And I want to, you're exactly right. And I want to say one other quick cautionary tale here as we're getting close, I realize, on our time, Ryan, but I just got off the phone with someone earlier today, and they had set up a policy. It was a pretty mega policy. I mean, guys, you can do these small, a couple bucks a month. I'm talking for kids, especially, it could be 60, 75 bucks a month. Mm-hmm. For adults, it might be $200-300 a month, maybe, but there's always ways around that if you can't even come up with that. So guys, really just don't let money be an issue. There's almost always a way to make it work. If you have a will, there's usually a way. Mm-hmm. But this one today, I was talking to her. She had a very significant upper 5 figures a year policy going in premium every year. Mm-hmm. And she had set it up with someone besides me in our firm. And it was not a bank on yourself designed policy. She thought it was whole life insurance. They paid dividends. It had a paid up additions rider on there. It even had non-direct recognition loans, all the gooey vocabulary that you hear me say a lot, Ryan. But as it happens, it was a company that I would not recommend. Mm-hmm. And there's a few reasons why. One, I'll just give you 2 quick ones to be brief. The expenses in the policy were baked in, where she was going to pay about 16% expense on every dollar she put in to the most efficient part of her policy. That's triple the industry average. Okay. She didn't know that. No one told her that. I bet you the agent didn't even know. And the other was, when you take a loan from this particular company, I won't name it, they charge all of your year's interest on the first day. You take a loan for 10 grand, they're going to give you a loan for 10,500 in the first day. So for these and other reasons, she's now transferring. She thought she had one of these policies. I guess the point I'm trying to say is, don't assume that your guy down the street knows what he's doing, or the gal that you met in college who has her life insurance license knows what she's doing. They might, but I would suggest make sure that they are a bank on yourself professional. There's 200 of us that have all gone through the training. We've gotten our certifications. We'll design it correctly. It's sort of like, you don't get into an elevator unless you know it's been certified, right? There's a good and a bad way to engineer elevators. Same with bridges. Same with my smartphone. Once you're in the elevator, though, you just push a button and up you go, right? If it's designed correctly. If it's not, you got problems. So make sure it was designed correctly and that it's being serviced and managed by a professional. I'd humbly submit myself, but there's a number of other bank on yourself professionals out there that could help you. So that's just one more, I guess, cautionary tale, Ryan, as we wrap up.
Sure. Well, you're the only one I'm recommending. I don't even know anybody else. So,
well, there's some better looking ones out there for sure. I'm sorry you're stuck with me.
No, I love it. I always enjoy conversations. Wow. Yeah, guys, just definitely give him a call. Go to, or just set up a call with him and his team. It's ryanrieger.com/bank on yourself. And set you up with a free consultation. And Mark's super cool because he'll just ask you some questions, and it's literally zero pressure. And he'll tell you himself if this is not a fit for you. But it's been a blessing to a lot of my family and a lot of our Legends members that are using this to help their business. It works really well with somebody that has a business. So,
and that link again was
ryanrieger.com/bank on yourself.
All right, cool.
Yep. Mark, anything else?
No, man, I appreciate you. Thank you so much. It's always an awesome time. Like I said, I was looking forward to this all day, and it's been a lot of fun. So thank you.
Love it. Appreciate you having you back on. We'll have you back on again.
Thank you.
All right. See you.
You've been listening to Streams of Income with self-help author Ryan Rieger. From right here in the Dallas Metroplex, Ryan teaches several entrepreneurial courses and group coaching programs to students all over the world. Be sure to listen next week at the same time for Streams of Income with Ryan Rieger.